as we get started, perhaps.
100%. Yeah, I
Yeah.
like that.
Still don't really
Um,
know how to get started, but
yeah, even if you're in the middle of a sentence. So no highs, no hellos. I say just dive right in.
yeah, well, I mean, over the past week or so, we've seen this policy continue to evolve a little bit. Admittedly, it's slowed down somewhat, but tariffs continue to be a cornerstone of early fiscal and even foreign policy under the new Trump administration. And so, over the past couple of weeks here, following some of these initial overtures that we saw with regards to Canada and Mexico and China. So, last time we were talking about this, we talked about the 25% that was going to be imposed, some last minute deal, but then a 10% on China that did get imposed. Since then, there have been a couple of actions to build upon this policy. First and foremost, after the imposition of the 10% tariffs on China and then their initial response, that was seen as kind of the first concrete action that was taken and was put into effect. Shortly after, there was a focus on steel and aluminum. So this was basically a broadening out of the overall policy beyond just North America and China.
This is another way of saying we're doing a 25% tariff on steel and aluminum. It's time for our great industries to come back to America. I want them back to America. This is the first of many. And you know what I mean by that. We're going to be doing others on other subjects, topics. Protecting our steel and aluminum industries is a must. And today I'm simplifying our tariffs on steel and aluminum so that everyone can understand exactly what it means. It's 25% without exceptions or exemptions. If it's made in the United States, there is no tariff. All you have to do is make it in the United States. We don't need it from another country. As an example, Canada. If we make it in the United States, we don't need it to be made in Canada. We'll have the jobs. That's why Canada should be our 51st state. So essentially, we're putting on a 25% tariff without exception.
25% on aluminum and 10% on steel, I believe. I think he said 25% on both. Typical Trump fashion, he's a little bit fast and loose with some of the details. So then online as well, the full text of the executive orders are available. So showing the two here, we'll add a link in the description below. This first one here, adjusting imports of steel into the United States. And then second, adjusting imports of aluminum into the United States. To summarize, it's talking about reinstated and increased tariffs. So on steel imports, that's 25% tariffs reinstated for Argentina, Australia, Brazil, Canada, Mexico, the EU, Japan, South Korea, and Ukraine. So basically without exemption, as he was starting to talk about. Aluminum tariffs raised from 10% to 25%, and it's ending prior exemptions for Argentina, Australia, Canada, Mexico, EU, and the UK. And some of the reasons that he gave. So in the text here, it mentions surges in imports. Steel and aluminum imports have risen significantly, undermining prior restrictions. Global overproduction, saying that China and some other countries are flooding the markets, depressing the prices and overall hurting U.S. industry of steel and aluminum production. There's also a bit about talking about shipment loopholes that some countries were taking advantage of, primarily China, saying that these metals are entering the U.S. through Mexico and Canada in order to avoid some of these tariffs that were previously in place. So plugging the holes on that. A lot of the reasoning here is for protectionism of U.S. industry. And then within the text here, again, it mentions how U.S. production fell below 80% of its capacity. And there's this argument with regards to national security that's used. And then similar for aluminum, it says that U.S. smelter utilization has dropped to 52%, which has then seen multiple plant closures as a result. So that's difficult for domestic production and job creation related to these industries. And so that's what he was saying in that video. We need to protect our industries and bring this production back to the United States. And then, of course, he also got that jab in there as well about Canada is the 51st state. Just make it in America. There's going to be no tariffs.
Yeah.
Canada, just join the country
Yeah,
already.
really. Okay, is there any indication or do you know kind of personally as to why the US maybe is not as competitive? Like why, I mean they're shutting down, that's not good to see. Presumably it's because we can't match them or compete on price.
So I don't know the exact details as to why, but the first time around, or during Trump's first term, steel and aluminum was a big thing as well. So I think there's a combination of these industries being key to some of Trump's voter base. The manufacturing industry that has long been decline in the United States. So this is seen as an action to attempt to defend that and bring some of the production back to the US. Why the US was less competitive in these areas over the recent term here, not knowing the full details again, but I think a lot of it goes back to specifically around China, where trade volumes are less a reflection of relative competitive advantage between these two countries and maybe just more a function between differences in regulations within these industries. So again, not knowing the precise details within aluminum and steel production within China as compared to the United States, but all else equal, the US typically has higher regulatory requirements. And so if another country like China just across the board has relatively lower regulations, all else equal, that's going to lead to lower production costs. And then they're going to look to increase their exports to the United States for that. And so, again, if then producers of other materials that use steel and aluminum as an input, it's going to look relatively more attractive, obviously, to import from China just due to lower prices. But that lower pricing might be kind of synthetically a function of not China is so much better at creating these steel and aluminum goods, but perhaps just practices of creating them that are not similar to the US.
I don't know. I mean, what are the factors that go into steel prices? It's like electricity. I think it's another big expense. You got these like arc furnaces or whatever, and then labor costs. I wonder. I don't know, unions, labor costs. They're probably. If I were to just guess, without looking into it, I'd wonder if we were just getting hammered on all fronts. If there
Yeah,
isn't
and
anything,
mhm. That's likely the reality.
yeah.
It's a
And then
combination of these different issues all working together that in place for many decades here. It's just a very steady decline of these industries within the United States. And this is an effort to try to reverse some of that more or less. So at this point, it still remains to be seen just how effective these kinds of actions are going to be. But as it stands today, these are new impositions of these tariffs that, in a similar form, were done in 2018. So we'll see this time around how different or similar, for that matter, some of the effects end up ultimately being.
do you support the tariffs? Just kind of curious.
It's difficult to say.
Yeah.
From a pure economic standpoint, it still is a very strong argument for free trade overall. From a political stance, though, much of Trump's base throughout his first term and now this second term here really are from some of these sectors that have just been slowly and steadily eroded for a number of decades now over time. So, from the protectionist standpoint, for individual industries within the US, individual voter bases with which it affects, you'll probably see some positive impacts. But if you're considering things on an overall national scale, even, then you think about like a global scale of just a flow of goods and services between countries, even, within the United States alone, you probably are going to see higher prices, just mechanically speaking, if you are literally increasing prices of importing these goods. To offset that, he's incentivizing domestic production, but it takes time to ramp up production again domestically, or for that matter, for other countries to then shift their production possibly from within their country to export to the U.S. to shift their production within the U.S. directly. So there are going to be some frictions, and all the knock-on effects to other industries are in all likelihood going to be a net negative over the short term. But that's one of the next questions. So that's one of the biggest criticisms of this. What are the impacts on inflation going to be from some of these policies? So that's one of the questions that the Fed has been continually asked over and over, and they just really don't know. They refuse to comment on it. They just say, this is politics, we stay out of it. Once there's a decision, then we'll comment on it. That said, these are formal actions that have now been taken. So it will be interesting to see how the Fed is viewing this, what they think the effects will be. and then ultimately how inflation is going to be impacted over the short term. And so that's something else that I wanted to touch on here. Some of the early impacts on inflation that maybe we're not seeing just yet, but some of the latest inflation numbers, most of which were still before Trump was in office, just given the current trajectory that has shifted very slightly, that may also complicate things going forward from here. So that said, before getting into inflation directly too much just yet, one of the other things on the tariff front that I wanted to mention is just some of the forward-looking things that were said over the past week as well with regards to some of the next steps. And a lot of that is around this idea of reciprocal tariffs, that after these steel and aluminum actions have been taken, that's the next point that he has begun really talking about quite a bit. And that's the next major action that is in his crosshairs. So let me show another clip real quick. So there's been just some early musings about this. There's been some early indications of what kinds of actions could be taken here. So this is something that Howard Lutnick, Trump's nominee for Commerce Secretary, has been working on. So he said so far that they're currently studying this, whatever that might mean, and they're looking at a potential date of, or I think they have April 1st as a deadline for these studies, within the intent of possibly adding in these new tariffs as soon as April 1st or April 2nd from here.
April 1st this year. That seems really fast.
Oh, well, yeah. I mean, like Trump prefers as soon as possible. If anything, it's kind of amazing that he's yielding to, some of his cabinet saying, well, we need a couple months here first to figure out exactly how this could be implemented.
Yeah, type up the report, format it. That'll take a few weeks right there.
I think this is actually mentioned on one of his day one executive orders, that very general, like America First trade policy. I think there is a section in there about reviewing all current existing trade policies in place. So in a way, these reciprocal tariffs fall within that. So let me just go back real quick to this initial video that we showed. After talking about steel and aluminum, then he kind of gives a brief look ahead about what we might have in store for some of these reciprocal tariffs.
I put tariffs on. We don't want it to hurt other countries, but they've been taking advantage of us for years and years and years, and they've charged us tariffs. Most of them have charged us, almost everyone, I would say almost without exception.
Definitely.
They've charged us and we haven't charged them. And it's time to be reciprocal. So you'll be hearing that word a lot, reciprocal. If they charge us, we charge them. If they're at 25, we're at 25. If they're at 10, we're at 10. And if they're much higher than 25, that's what we are too. So that's having to do with everything. That's not just steel and aluminum, but we'll be discussing that over the next couple of weeks. But we will be looking at chips, and we will be looking at cars, and we're going to be looking at pharmaceuticals, and there'll be a couple of other things also in addition.
Mr. President.
So a little bit light on details there, but he's just introducing the idea of what some of the next steps are going to be. So rather than what we saw from the start, instead of calling out individual countries, he wants to simplify things a little bit. He's broadening the scope to effectively all other trading partners and simplifying things in that he's not going to be picking and choosing which countries at which levels on which goods are going to see tariffs, but rather we're just going to match everything of all tariffs that other countries are putting on the United States. The United States will match that on a country by country basis. So that simplifies things in that whenever we saw the initial rounds with Canada and Mexico, like same day or next day, then that's when we saw Trudeau talking about orange juice tariffs and all these different things, these retaliatory tariffs. So in a way, this kind of neutralizes that kind of effect, or removes that tool that other countries could have in response to this. So it's saying, well, we're just going to match what you have. And implicit to that, if they want to retaliate in some way, then this is saying, well, those retaliations will then be matched as well.
I wonder about that. Orange juice sounds sort of like a good example here. Like, what are we going to do? How much orange juice does Canada export to the U.S. and then vice versa? I wonder if we're just going to give them 25% across the board. That would that would hurt. But it's when they respond, at least when Trudeau did, he said, okay, there's 100 whatever billion, and we're going to specifically target certain products. How would, I guess would be a question to the president, would you suddenly just do a reciprocal tariff on something that we don't even import? So like, what's going to hurt? I think that's point one, I guess, just as a like response. The second thing is I think maybe Trump looks at the high level numbers and just sees that the US has a fundamentally better position in a trade war because we're already running a deficit. So like at maximum, like from China or whatever the number is, say it's $1 trillion that we are importing and then we're exporting, 800. We can just have a larger kind of piece to tariff. Like, so, we could hit $1 trillion of goods, and the most that they could do is hit like 800 million or something, 800 billion.
Exactly. And so that's what we saw with the 10% imposed on China. I believe the exact number in 2024 is the U.S. imported $525 billion worth of goods from China. And then the U.S. imported, I forget the number, but it's the deficit is on the order of a couple hundred billion. So right off the bat, the U.S. imposing 10% across 525, that's $50 billion in additional tariffs potentially across the board there. And in China's initial official response, like we mentioned last time, in addition to reviewing like Google and some of these rare mineral export controls.
Yeah, that's kind of the dirty part. That's one thing that you can't really just tariff.
But I mean, they were forced into it
dirty
because there's just, like you were saying, just a much smaller base of imports that China is importing from the U.S. And then the tariffs that they did put in place applied to something like $15 billion worth of goods. So Trump's move was to put tariffs across a base of 525 billion of imports, and China's initial move was on a base of U.S. imports of like 15 billion. So there's definitely a big imbalance there.
Interesting. I
you were saying.
But yeah, I mean, if he just, but kind of what I don't know if he's suggesting here, or if the read was that if it's purely retaliatory tariffs that they're going to match, it's the reciprocal ones, or if they're just going to like hit go and then we're going to match all of China's import tariffs from the U.S. So remember we saw here a couple episodes ago when we actually looked at the Chinese tariffs that were going into, and the rates of the Chinese tariffs of U.S. goods going into China, they were all just like way higher. Do you think he means that we're just going to hit just one for one, like across the board? That would be an interesting approach. That would be super simple. That would just be like, if anyone gives him crap about the tariffs, he can just point across the ocean and just say, look, I'm just doing the exact same what they're doing.
And that is precisely what he's been shooting for here so far. Yeah. So there hasn't been official guidance yet. No executive.
That would be pretty effective. You cover your ass a little bit. It's not me. We talk to the Chinese. What if they bring it down? We'll bring it down.
Yeah, exactly. And he basically makes that point.
That very strong.
Sir, do you have an update on the European Union is talking about banning food imports from the U.S. kind of along the lines of your reciprocal tariffs. Like the reciprocal tariffs, they don't like the peasants.
All right, I don't mind. Let them do it. Let them do it. They're just hurting themselves if they do that. I can't imagine if it doesn't matter. We're having reciprocal tariffs. Whatever they charge, we charge. Very simple. If a certain country like India, which is very high tariff, if they charge us X dollars, we charge them X dollars. It's all right. It's a fair thing to do. Even the media said it was fair. And it's going to be very good for the United States.
Super simple. It's just to get all the criticism kind of gets off his back. So like politically, it's pretty clean. And then, yeah, you're right. It's kind of blameless. It's just like, look, we've been taking kind of interesting. I mean, I understand just the sense of fairness. It's just like we've been taking advantage of all this time. It's like we let them come in cheap, but we have to pay extra when we export. And we're just like, screw it. Just cross the board 1-to-1. And then if someone likes, the WHO or whatever, gives them a hard time, be like, don't talk to us, talk to them. Fill that argument in one sentence.
Yeah, so it's definitely going to be interesting to see what the net effects of this will be, and so not shown here, but he mentioned separately that I think they said they have like a April 1st deadline to, I guess, finish this study, or I forgot if it's the study and also
Nice.
like the plan of how to implement these things.
Yeah,
But he
that'll
had
be
a
a good
separate,
read. And then you
yeah,
can,
definitely.
come here, the Root of All Evil podcast, for like an in-depth review of it.
Future episode coming soon.
Absolutely. April 1st. I think it's just a huge April 1st joke.
We shall see. Given tariffs, given all of this, like we were saying, even with these reciprocal tariffs, there's going to be some frictions that come along with this. Domestic companies that are buying certain goods might have to switch who they're buying from. They might have to just pay more outright with tariffs. They might look to shift some of their purchasing to other domestic sources where they aren't facing higher prices, but just the act of making that shift incurs prices in a way as well. And so all of these things suggest that there could be a bump higher in inflation. And so that's one of the things, obviously, that Trump criticized the previous administration quite substantially about. I think reasonably so. We saw the highest inflation at least since the 1970s, certainly. And then with that in mind, we just got the latest inflation numbers from January 2025. So this past week, the CPI report for January came in.
Let's do it.
And let's dig right in here.
Heard there was a little bump in the night.
There was indeed a little bump.
Oh,
Official report. This is the official release from the BLS. So they released this big this big PDF, kind of outlining the numbers in great detail, and then breaking them down. Where's the inflation coming from which sector, from which sector of industry, from which part of the country. So Jan 25 says CPI for all urban consumers. The average for the entire country that is most cited whenever people are trying to get a finger on the pulse of where inflation is headed. So for January, this number increased by 0.5%. And so they do the seasonal adjustments just because naturally every month in the year, you've got some movements up and down that you expect to happen every year. So adjusting for those over the month of January, there was a 0.5% increase on prices. That compares to 0.4% in December. And then looking at that on a year over year rather than a month over month basis. So from January 2024 to January 2025, all prices increased in aggregate by an average of 3.0%. And then it goes into breaking down what some of these individual items are. There's a ton of information to go through here. We can link this below. But just taking a look at the top line here. So this first chart is showing that month over month value, that seasonally adjusted headline value. So in January, 0.5%, 0.4% in December. Back to last May, it was actually flat. There was no inflation over the months of May and June. So but again, no inflation on average. So all of these underlying components, some prices went up, some prices went down. So in those months, it all came out to a wash. There was overall, no increase in the overall consumer price index. Since last summer, we've seen this gradually start to tick upward. It's a point of debate as to exactly where this is coming from, or, is this a shorter term bump, or is this something that we're seeing a re-acceleration in prices after declining broadly since 2022? Have we kind of gotten as low as we should expect, and we're going to keep increasing from here? That's really remains to be seen. But that's the context we're seeing here. And then again, switching from the month over month, to the year over year, here's just showing that context as well. So the blue line, it's that headline yearly rate. So back into mid last year, it was declining and it hit a low of 2.4% in September. And it's been gradually ticking higher ever since then. So it's now at 3%. Just briefly touching on the core measure. So that's the burgundy line. So that's taking the same measurements here, but removing what they call some of the more volatile components, food and energy items.
I'm surprised why is the burgundy line above? Why is the core higher than the more volatile ones? For whatever reason, I had the
Right.
assumption that food was kind of maybe a driver, but here it looks like it's not.
Yeah, that's a great question. And that's one of the core reasons why the Fed typically looks at this core measure. You'll see, like over a longer time scale, you would see this blue line kind of become higher and then become lower again than the burgundy line a lot. It would bounce around a lot more for various reasons. Food and energy are more volatile components. You can have changes, unseen changes in weather, energy policy around the world, all kinds of different things. Looking here over the past year, it's been consistently below the core measure. And a couple of years before that, it's been below that core measure. So fundamentally, what that means is if you're typically below, if your blue line, if your all items is below the core measure, that means that all else equal, the core items have continuously seen higher inflation still than some of these headline items, including the more volatile food and energy. And that's the thing that the Fed sees that they have more impact over. When you think about core items, you're thinking about things typically like services. So rather than producing individual items, the US is very much a service driven economy. It's more difficult to get a read on how the price of a business service. This inflation has still been higher. And so this value, Fed has a 2% target. Last year, it was almost at 4%. It's come down to as low as 3.2%. And most recently, it ticked up from 3.2 to 3.3. So this is the measure that the Fed has their eye on. They've got a 2% target. This is still over 3%. So the Fed is probably seeing that their job on inflation still has yet to be completed here. And so that's a lot of what we've seen in some of the recent FOMC communications, that they're watching this closely. Compared to last year, whenever they saw inflation coming down more consistently, they were of the view that it was going to keep coming down. They thought they would be cutting rates more. But over the past 6 months, we can see that it might have bottomed out from here. And in fact, on a headline basis, it could be increasing again.
Jeez, I didn't realize it had been increasing for that long.
Mm-hmm. But again, we're talking about 0.1% on a month over month basis. But
Yeah,
this has
I'm,
been
I'm
going
looking
on.
back at September though.
Yeah.
Ooh,
Yeah.
it's
So,
going in the wrong direction for a while now.
right. So we're about 0.5% higher there. And so that's a great question. What is fueling this? So again, that core line is basically pretty flat still. So, you assume that that's food and energy items. That's going to be less sensitive to kind of underlying monetary policy concerns. But politically speaking, so Trump needs to look at the all items line. So the Fed is typically looking at this burgundy line. Politicians are more focused on the blue line because this is what everyday people are facing. It's a better reflection of that. So there's some things that politicians have control over with that. There's some things that they don't have control over. But this is kind of the background of where we're at right now. So whenever we're talking about things like new tariffs going into place, and it's generally accepted, even by Trump, he says that there could be some short-term pain involved. Even he admits that this could bump higher.
Yeah.
The question is how much higher and for how long?
Yeah, fun fact too, for the month over month number, that 0.5 number that you showed, 100% of that 0.5 came in the last 10 days of the month. As soon as Trump hit, as soon as Trump was signed in, oh man, inflation just took off.
Yeah.
That does seem to be like
came in.
continuing a trend. Yeah, but that is
Right.
weird.
So
just like
that's,
services.
yeah. So that's definitely one of the tricky things that he's going to have to deal with, because now obviously any of this he's going to be blamed for. But this number on the screen that we're looking for, he was only in office for the last third of the month. And, what did he really have impact over for those couple of days so far anyway? So he is inheriting this gentle creep higher so far in these headline inflation numbers. So it's, something else that he's going to have to juggle with these tariff effects.
Not to kind of switch over to kind of one of my topics, but I was listening to these banking committees, and one of them that was held recently, just like a couple days ago, within the last week, was the semi-annual, monetary report that's given by Powell to the to Congress. And, I got to hear Senator Warren. She urged him to cut rates. And just in that context, I didn't really think much of it. But in this context here, that doesn't seem like it's going to happen. What is the forecast now for cutting rates? Do they still think there's going to be 1 or 2 in 2025? Or are they pushed back to 2026? Do you remember?
Most recently, I think by year end 25, they're still expecting just over 1 full cut. And I think like maybe by the September meeting, that 1 full cut is fully priced in. Whenever we say they as well, it's like, who are they? Like, what are expectations? Maybe we should cover this more fully in like a, special aside video or something like that. But people are typically talking about these market pricing implied expectations. There's these financial contracts that price out what the underlying Fed funds rate will be. So whenever the Fed raises or lowers rates, they're talking about the Fed funds rate. There are derivative contracts tied to that underlying Fed funds rate. And so market participants trade these freely in total absence of anything that the FOMC is doing. So that's where this market implied expectation for cuts come in. So yeah, most recently, they're expecting just over 1 cut over the next 12 months or so. And this is pretty drastic. This is a pretty drastic change. If I remember correctly, late summer or maybe in September last year, that number was like...
Back when, back if you scroll down, like back when we were having these conversations in like August and September, people were
right
like,
around
we beat inflation. And I imagine a lot of banks and anyone else who follows interest rates, they were like doing their budget around that time and pricing in a whole bunch of cuts.
Yeah.
They were expecting a whole bunch of cuts. And now it's like, whoop, never mind.
And I think the number was by the end of 2025, so like 15 months ahead.
4?
They were expecting 10 cuts.
10.
10 interest rate cuts. So since September,
that's 2.5%. So we have 1 cut.
So the Fed delivered 4 of those cuts. So in September there was 2. In November there was 1 more, just after the election.
Yeah.
And then,
So that's how things change.
Yeah, 1 in December. So, but even above and beyond those 4 that were delivered, there at this point they would have been expecting 6 more by December 25.
Okay.
So now that's gone from 6 to just over 1.
Yeah, maybe.
So
who knows? Maybe there'll be hikes. Don't know.
Honestly, if you look at this blue line, if that keeps moving higher,
that keeps going up. It's getting in the conversation.
If you become closer to 4 than 3, that's the conversation will probably be far different.
Interesting stuff. That's a good context. I really got to do a better job of following up with this. That's you. That's your job, Joe. Get me up to date on this stuff because I don't pay close enough attention to like what rates are and where they're going.
Mm-hmm.
I should.
Well, every month, don't worry. We can pull up this
BLS
report.
Make it a little segment. Fine tune it.
Yeah, and like that's kind of a good question. It's like, where should we have like separate, like smaller segments where we're just kind of reviewing, what this report is and kind of putting it in context, or should we just bake it in with topics that it makes sense for? Like we've been covering tariffs a lot recently just because they've been a major policy point and directly tied to inflation, et cetera, et cetera. Yeah.
That's a fair question. I mean, I think in terms of what we want to get out of this podcast personally, I think we can maybe treat our audience or each other as like, management of some sort of financial institution and keeping them updated.
Mm-hmm.
That'd be kind of cool if you can treat the, and then on my side, I focus more on, it's kind of banking, regulatory stuff. And like kind of what I'm hoping to cover now is this, debanking thing. Could just kind of cover what happened in the world of like Senate hearings, what, maybe any big cases that got hit with banks, bank failures, just get you updated in the last week, something like that.
Mm-hmm.
So maybe we could do like a really quick overview of like the committee hearings, or just like really quick, and then just dive into one of them that has the best story. And then I would be able to keep up to date on this stuff because I'm researching it. You would. And then on the other side, you can think about that. And then, for the audience, kind of tailored to smart people. So we'll speak to them as though they're not necessarily in the financial industry, and so we might have to provide a little bit more detail on some of the background of this stuff.
Mm-hmm.
But in general, they just kind of want to keep up to date in the finance world. I don't know, man. Still searching for the kind of who we are.
Secret sauce here.
It's a pod sauce. Yeah. Kind of what to cover, but I think we're finding it. I think we're zooming in.
I think we're getting there.
All right, man.
Cool.
Right, good stuff. Thanks for the update.
Everything I wanted to touch on this week. I'm sure there's going to be more to come.
Thanks a lot. All right. Thanks for tuning in.
Good.
The Root of All Evil podcast. See you next time.